Let the bad times roll. What can I say? When Salesforce lays off 8,000 people, or 10% of its staff, and the stock rockets higher, you have the blueprint for a tech turnaround. Given the tech's been an ongoing disaster, a millstone around the neck of the market. More than 3% gain in Salesforce in the wake of that news today confirms that even software as a service stocks can rally. A charge of approximately $1.4 billion to $2.1 billion led to a nearly $5 billion gain in market capitalization for the Cloud King. Yes, and I think that the Cloud King's move is just beginning.
House of pleasure.
That's one of the reasons why the things were fine with the Dow ultimately up 133 points, S&P advancing 0.75%, NASDAQ climbing up 6.9%, despite some downbeat comments from the Fed in month-old meetings that inflation is still raging. Salesforce CEO Mark Benioff didn't mince words in his letter to employees. Quote, "The environment remains challenging and our customers are taking a more measured approach to their purchasing decisions. With this in mind, we've made a very difficult decision to reduce our workforce by about 10%, mostly over the coming weeks," end quote. Wow. It's Mark Benioff. The overexpansion was their own doing. As he articulates, quote, "I've been thinking a lot about how we came to this moment. As our revenue accelerated through the pandemic, we hired too many people leading into this economic downturn that we're now facing, and I take responsibility for that," end quote. Tough and good. All right, this isn't the first time layoffs have propelled big cap techs higher. Meta Platforms, for instance, chopped 13% of its workforce on November 9th when the stock was at 96. Now it's at 127. Again, too many people, too few revenues. This was Mark Benioff. Now, I'm not saying that we're going to cost-cut our way out of this remorseless market. That doesn't work. If businesses keep cutting back on marketing, Salesforce will have to fire more people, perhaps prodded maybe by this Starboard Value, the activist firm that's encouraging tough Ohana love that has a lot of shares. If Mark Zuckerberg, founder and CEO of Meta Platforms, can't figure out how to monetize the metaverse, doesn't spend more time on Reels, his version of TikTok, then he's going to need to let a lot more people go, along with a lot of real estate. But at the end of the day, this market has become unforgiving to the fat, happy tech companies that hired too many people during the pandemic and are now seeing that they're not taking the tough actions needed to protect you, protect you, the shareholder. The kind of actions that a steelmaker or a chemical company will do reflexively going into a downturn. They know how to do it.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.